Hey guys, welcome back to the channel. It's been a while since I've done a stock market update, and with the election this past week, let's go ahead and talk about the stock market, what's happened, and then I want to show you a clip from Jim Cramer's CNBC show Mad Money. And I definitely refrained from posting any videos or talking about the stock market leading up to the election because I knew there was going to be a lot of volatility and uncertainty. And when you see what was happening, maybe it peaked on October 12th and it was down 7.5% all the way up until October 30th, where it bottomed out, and then it's up. It's up 7.32%. The election was on Tuesday, so it's up almost a little over 4% since the Tuesday election. So if you were getting anxiety about that election and you decided to sell off your portfolio, hold cash, you lost out on a little bit of gains. And there were definitely lots of other YouTubers posting daily about the crash is starting, the market is about to crash, don't be fooled. Same thing with Jeremy from Financial Education, stock market is crashing. 22 stocks to watch in this crash. Stock market crash is getting worse. I posted a video last summer in September saying, will the S&P 500 go to 4,000? Why the stock market only goes up now? And the premise of that video, you should definitely check it out. There's solid information there. But the premise is that there's nowhere for this money to go. All of the money that the Federal Reserve and the federal government is printing and injecting into our economy. You have to remember that this number, 3,509 for the S&P index, this stands for $35 trillion. So when it goes down to 32, that is $3 trillion that just kind of poofed. Now it's, the velocity of money in the market can cause the money supply to shrink or expand, but mostly it's just people selling off their stocks and then holding cash in their brokerage accounts. They're trying to time the market, cause a downswing, jump in, ride it back up. So when you see the market doing something like this, going down 6 or 7%, if you're a buy and hold investor, just ignore it. Don't get spooked by that because it's just going to go back up. When you look at what's been going on since September, goes down, goes up, goes down, it's gone back up. It's probably going to go down again, but I guarantee you it's going to go back up. So I want to show you this clip from Jim Cramer's show. I think it broadcast on November 5th. And he's talking about why are stocks going up when necessarily the valuation for those stocks hasn't lined up with what we've traditionally valued stocks at. What is a good price to earnings ratio, so forth and so forth. There seems to be going forward this new standard of what is a fair valuation for stocks. What are people willing to pay for it? And as long as all the other investors use this new metric, that's just the new standard. Stocks are going to go up because people are valuing them more today than they have in previous eras.
So bonds have lost their luster as a repository of wealth, and it might be permanent. But what about the repository of wealth that stocks represent?
So bonds are losing their appeal to investors. They're just not giving good enough yields, especially government bonds, especially with the Federal Reserve stepping in and buying up the junk bond market. There were good APRs there for riskier loans that the federal government is now guaranteeing to private companies.
I remember the day I first walked into Goldman Sachs. It was 38 years ago. I got schooled by someone who's now an old friend about the value of stocks versus bonds.
So he's saying that he used to work at Goldman Sachs 38 years ago, so that was in the mid-1980s.
Oh, I love stock market. That's why I went to Goldman. I love stocks. I had all these tremendous ideas. I wanted to tell everybody about them. He let me go on and on until I named enough stocks to create a Jim Cramer index, and that was before there were ETFs. Then he looked at me, and he said...
Before there was ETFs. Yeah, this is the 1980s.
Said, never mention those stocks or any other stock ever again. Ever. What the heck are you talking about? I love stocks. I love stocks. told me, he let me let you know a little secret. Stocks, they go down. Bonds, they don't go down. I said, but I could never make that promise. I wanted to make people money. And this is Goldman Sachs. He basically said, no, I know what I was talking about, especially since the clients I'd be talking to were already rich. You only need to get rich once.
I really like that expression. You only need to get rich once. So these investment banks, Morgan Stanley, Goldman Sachs, Bear Stearns is gone, Lehman Brothers is gone, Salomon Brothers is gone. But back in the 80s, you know, those banks, those investment banks were basically fee harvesting operations. And rich people came to them, and their goal was to make those rich people feel like their wealth was protected. They're already rich. You don't need to make them rich. You just need to preserve their wealth.
All these people simply wanted to do was preserve their wealth. They didn't care about generating huge gains that I couldn't deliver on anyway. Okay? Stocks go down. Bonds don't. But what if they actually wanted to own stocks, I asked. And he said, he told me that I had to discourage them at all costs to ever buy a stock. Because if a single stock went down and they lost money, we'd lose the whole account.
So if they were to put their clients in stocks and the stocks were to go down, it doesn't matter as the broker or the advisor you explain to them, well, just hold on to them, they'll go back up. Clients, wealthy clients, if they don't understand how the markets work, if they see their account go down at all, they freak out and they might close that account, pull out all their money, and then move to a different investment bank. And, you know, especially those large clients, you know, it's a fee harvesting operation. That's how those investment banks still to this day stay in business. Wealthy clients that don't really understand how the markets work, and they just need to keep them as clients and keep them happy. And traditionally, they've done that with bonds, corporate bonds, government bonds.
So I begged him, I said, well, what if maybe let him buy a couple stocks? He said, make sure it's their own ideas. You keep your ideas to yourself. As it happens, I ended up doing both. I helped my clients stay rich, and I kept my ideas to myself. Specifically, I invested my own money. I made a fortune enough to own my own hedge fund, and then retire and do the darn show.
So Cramer started his own hedge fund. I don't know how long he's been with CNBC. It's almost 20 years.
That's my life's arc right now. It's all right. Could be worse. Now, it worked out well, I think. But what does this story have to do with today's miraculous rally or the endless rally? Frankly, everything. Everything. And no one else is talking about it. You see, if you put me in charge right now of that Howell division at Goldman Sachs, I'd say, when rich people come to see you, you have to tell them that they need to take less risk and preserve their wealth. That means they need to own a lot fewer bonds and a lot more stocks.
And that's exactly what I think is happening. Because bond yields, especially government treasuries, are so low, these large investment banks are telling their wealthiest clients, hey, I know in the past we've told you, we're going to set you up with bonds, but perhaps, the valuation of these companies, even though they look rich, they look overpriced by traditional metrics, maybe there's a new standard. And it is safe to have your money in stocks because you can earn a little bit more.
Yet this year we're witnessing the passing of the torch. Bonds were the safest assets back in '82, back when treasuries yielded double digits.
Back in 1982, U.S. treasuries yielded double digits. You could buy 30-year fixed treasury notes that yield, I think, as high as 14%. Why would you ever buy stocks when you could guarantee yourself 14% a year?
Now they're risky assets, maybe riskier than one thinks. Sure, you only need to get rich.
How can bonds be risky? Well, if government notes are only yielding you less than 1% and inflation is 1 to 2, potentially higher, you're losing money. You're losing money to inflation by not being in stocks.
Once, but if you want to stay rich, the old shibboleths won't work anymore. The truth is, for many companies that we follow, the equity side is a much better, safer side, a much better repository of wealth for you, the individual, than the credit side. Not all of them, but a surprising number. Think about what's 25% of this market? It's the Microsofts, the Apples, the Facebooks, the
All right, he's going to talk about big tech and potentially why it's still a good investment. Now, in this video where I talk about the S&P 500 going to 4,000, you think about what's coming up the next 2 months. Congress, now that the election is over, is potentially going to pass a stimulus package that's probably going to be in the $1 to $1.5 trillion range. We're not going to get that Democratic blue wave sweep bill worth $3 trillion. So it's going to be scaled back, but that's still more money going into the markets, going into the economy. We're also going to get a vaccine. I definitely think by January, we are going to get an announcement and a rollout, and they're going to start vaccinating people. Now, the logistics is complicated. It's going to take months for 7 billion people around the world to get the vaccine, but just the news of it being announced and that it's safe and that it's going to be distributed, that's going to be a huge confidence boost for investors. Money's going to flood into the market. So we're already nearly at all-time record highs. The market peaked on September 2nd at 35.80. It's currently 35.09. Factor in another stimulus bill and a vaccine announcement. Are we going to hit 4,000 this year? I definitely want to get the point across in this video that if you're sitting out right now because you think there's going to be some crash, I personally don't see it coming. It's your money. You can do what you want. If you want to hold bonds because you feel like they're safer, that's your prerogative. You definitely have to factor in your own risk tolerance. However, just from what I'm seeing, I've got the green light here. I don't see any reason to not be invested 100% in U.S. equities. Okay guys, I just wanted to share that with you. I thought it was interesting. If you like this video, give me a thumbs up so the algorithm knows it's good. In addition, leave me a comment down below if you have any predictions or thoughts of what's going to happen in the market in the next couple months. Starting in 2021, I definitely am going to be posting more about individual stocks and stock market investing. I know the last couple months I've been posting a lot of reviews, tutorial videos, and just kind of instructional videos. But I am going to talk about current events much more coming in 2021. So stay tuned for that.